Private credit is so sexy right now. Okay, I can't believe we actually did that. Okay, but seriously, we are bringing on the absolute GOAT to talk about one specific element of private credit. And the reason is this. We are going to be talking about distressed debt investing today because if you've been reading the news, we are filming this in the winter, fall, whatever this is.
2025,
November of 2025. And if you've been reading the news lately, it has been dominated by headlines about things going wrong in private credit space.
Well, it's fraud, it's bankruptcy. You have Tricolor that's liquidating. You have First Brands doing what's called that Chapter 11 reorganization. I mean, it's like basically like, you know, little landmine. So,
and everyone's been talking about something called LMEs, which is liability management exercises, which is the very, I think, sanitized way of talking about something that is otherwise referred to as creditor-on-creditor violence.
Like basically you're screwing over the people who are in your, you know, in your little asset class, if you will.
Absolutely. So private credit has been the hot asset class for the past 2 years. I think it's been what private equity was in kind of the zero interest rate policy environment. I think ever since the Fed started hiking rates, well, really ever since the global financial crisis, private equity was the logical outcome of all of the regulations that were put in place after 2008 to really decentralize lending and de-risk the system so that everything wasn't so concentrated with, you know, an oligopoly of 6 American banks.
I mean, look, the classic private equity model, buy a company, pile a crap ton of debt on it, and when you have very low interest rates, you can put a lot of debt on that, and you can lever the crap out of it. So a lot of the private equity firms did very well. But what ultimately started to happen is that you started to have these other players who started to actually do some of the lending because the banks could not do as much of the lending as they had in 2008. There was a lot of problems that arose. So it started to shift where you would have the Apollos who historically were doing these private equity buyouts all of a sudden now being like, we're going to start to get into this lending. But they would charge a higher interest rate versus if you went to a bank. And so we started to see, again, this shift towards what's called this like private credit. And private credit, again, they're having a moment because you could do very well, blah, blah, blah. But as there's a huge amount of demand for limited deals, what happens is that all of a sudden, everyone wants the same things. And so the protections for lenders, like if you're lending money to a company, protections start to go away. The amount that you're going to be compensated, right, the spread is going to get lower and lower. And so all of a sudden, there's too much, I mean, how would I say too much money, but there's a lot of money chasing the same deals. And as we said, as you now have like these potential blowups and problems and reorganizations, people who were able to get away with investing in, you know, whatever, they're like, just give me an allocation. All of a sudden now, they're potentially about to get J screwed. And so we're going to talk with Michael Gatto about what J screwed means and the creditor-on-creditor violence and like all these potential pitfalls that people were not thinking about when like everything was going up and the world was, you know, amazing.
Friends, as you can see, we are recording this in a proper studio live. Hopefully this is the first of many more podcasts that will be recorded this way. The actual interview with Michael Gatto was filmed in our traditional method. But we are still adjusting to having like professional setups and mics in front of us. And apparently we are just bulls in a china shop. But all of that was correct. And I think the reason that Michael Gatto is such an exciting guest is he is not only one of the greatest investors of all time and a brilliant mind in the space who is still active at a very large private credit hedge fund, at a private credit fund.
Not a hedge fund.
I know, not a hedge fund.
By the way, you will see us talk to him and I'm like, basically like, how do you like to be described? And so we kept a lot of that in because it was wildly entertaining and just speaks to, again, the character that he is. He is so much fun. But sorry, continue.
But no, not only is he an investor, but he is a teacher at heart. And I think he shares so much of that in common with us. And he has just released a book called The Credit Investor's Handbook. And it doesn't read like a textbook. If you want to learn about this area of the world, if you want to learn about what it takes to become an investor in this space, it is the Bible as far as I'm concerned.
Well, and we talk about this in the interview, that when you're reading the book, it's funny. It's like the first, call it 50% is basically all of the things that I used to teach in the traditional investment banking, private equity training programs. Like you need to understand fundamental valuation. You need to know how to think about, again, valuing a company, putting together a projection model, all those things. But then it's like there's so much more that you have to understand. It's not just that. It's that, okay, what happens when things go wrong? What does the bankruptcy proceeding look like? What evaluation fights look like? What does subordination look like? It's like all these other things that honestly, like I was totally clueless on. So for me, it was really, really fun to read because I just got this amazing education in something that I had no idea about. But again, the first half is like again, it's the foundation. And then it's like the second half is just like, oh my gosh, like mind-blowing emoji everywhere.
It's the perfect desk companion to someone who's reading something like The Caesar's Palace Coup, which we talked about early in season 1 of our podcast. Also a phenomenal read. And I think what's really interesting about both of those things is the critical part that legal expertise plays in understanding all of these things. And we asked Gatto this on the podcast, but because this is our podcast, we can disagree with our guest in the little preface, and they're none the wiser. You know, we asked him explicitly how much being, you know, having an attorney's mind or background is important. And he was like, well, no, you can kind of just learn that as you go. But I actually think for those of you, too, who come from a legal background, who are thinking about where can I insert myself into the world of finance, what's a good, like, you know, insertion point, if you will, for someone with that background, distressed debt investing, I think is hands down the best place to take some of that legal expertise and find entree into the world of finance if that's something you're trying to pursue. So, I mean, this is one of my favorite all-time interviews we've done. He is just an amazing personality, and we're lucky to have him on. So let's get to it.
Awesome. How do you like to be introduced?
I like to be introduced as the supreme leader in all of society, of all things good in the world. So Kristen, you could go with that, or you could say I head all of the private side businesses at Silver Point.
And you guys define yourself as a credit investing hedge fund or asset management firm? What's the
asset management? We don't like hedge funds. It's beneath us at this point. No, I want to keep all this in. You can keep it all in. We manage about $41 billion of investable capital, and we invest in the credit markets, performing and non-performing.
Awesome. All right. We are so excited to be joined today by Michael Gatto, the author of The Credit Investor's Handbook. Jen, if you would do us the honors. He is the head of private side investing at Silver Point, which is a $41 billion credit asset management firm, not a hedge fund. And I'd love it, Michael, if we can start with your story, because you have just the most wild background. Like, honestly, I think so much, no offense to everybody else, but cooler than like most other people who get into the industry. So if you could start by just introducing yourself.
A-Rod's in the background taking notes, being like, thanks. My intro just got totally shafted from Michael Gatto.
Well, first, I agree. I am more interested than most people that you interview. But no, my background was a little screwed up. Like, I went to college. I graduated. I had no job. I moved back home to Brooklyn, New York, and that was before Brooklyn was like cool and hip, you know. 35 years ago, we were bridge and tunnel actions, you know. You went into Manhattan, and the two ways not to meet a girl at a bar is, one, to say I'm unemployed and I'm living at home, and two, I took the D train into Manhattan, and I live in the southern tip of Brooklyn. So yeah, my early days right out of college were like sad and depressing. And then I got a job, data inputting at KPMG, Pete Marwick. It was like, I'm going to blow my brains out if this is my life. And literally, it was the time before things got downloaded. So they would order every annual report, every proxy statement, and they just throw it on and say, download all the information. And I was a data inputting. So I went to Columbia Business School to reinvent myself. I got a job at Citibank, and Citibank had this amazing credit training program. So you got hired out of your MBA, and then for 6 months, they taught you how to take that academics and apply it to real-world credit investing. And so I went through that program, and then after that program, you went through rotations, and you get a permanent home. So they told me, look, we got to revamp the entire credit training program. It's old, it's outdated. We want you to do your first rotation working on updating the cases, the materials. And I said, no, I don't want to do that. I want to get out and I want to work. And they said, well, you misunderstood us when we said, would you do this? We're more telling you, you have to do this. So I actually went and worked on the revamping of Citibank's credit training. And I found that fascinating because I was learning a ton because I was meeting people who did deals, writing cases, working with academics to teach the cases. This is well before there was Training the Street or Wall Street Prep. So the people who taught these training programs were high-level academics or practitioners. They weren't professional trainers. So I really enjoyed it. I ended up never going to the line and working on deals. I just stayed in credit training at Citibank for about 2 years, and then I left to teach. So I was teaching banks and investment banks around the world the credit training programs. And I was making a name for myself. There weren't a lot of people doing it. And while I had 0.0 experience, no one knew that because I was a good storyteller. And I remember one of the banks said, "Can you teach a full-day seminar on cross-border M&A?" And I was like, "Absolutely." And I said, "The only thing I want to customize it for you, can you put me in touch with a vice president in it?" And then I had that person give me all their deals, and I taught myself. I wrote a case, and I taught it. But then all of a sudden, I was an expert in it. Because, if you're teaching, you must be an expert. And I loved it. My life was, for the first time, going okay. It was a lot of fun. And then I get this random call from Goldman Sachs. And Goldman Sachs traditionally was M&A, equities. It really wasn't 30 years ago a big credit shop. And these two brilliant young partners, Bob O'Shea and Ed Muley, were building out all of the credit investment businesses for Goldman. They were recruiting people. And Bob called me and said, "Hey, we've heard you're the expert in credit. You should come work at Goldman." And I said, "Sounds good." I went through 10 rounds of interviews. It was brutal. And case studies, everything. And they gave me a job. Again, no one really dug into, did you do any of these deals? Because the answer was no. But I could talk about them so well that it didn't matter. But the only problem is, when they made me the job offer, I had all these clients around the world that I was engaged to teach, and you guys did teaching, so you can't just call and cancel. So I cut a deal. I would start in 1 year. I would sign the contract today. I'd wind down my business, meet all my obligations, give away my clients, and I would be at Goldman in no more than a year. The goal was to wind it down in 8 months. So I do it. I give away a great business that I loved. And 2 weeks before I'm supposed to start, 1998 happens. And most of your viewers weren't born. They were young. But that was the Asian crisis that then got contagion, and Russia defaulted on bonds. And then long-term capital, this massive fund that had all these ties into every bank, collapsed. And it was a real financial crisis. At the time, it was like a 2008, even though 2008 overwhelms it. And one of the macro desks at Goldman took like a couple of $100 million loss.
Wow.
Not the desk I was going to go to work on, but I got a call 2 weeks before I was supposed to start, giving away a business. And they said, "Look, we're going to slow down our credit initiative. Macro desk took this massive loss. There's no job for you. Sorry. But we feel bad, so we're going to treat you fairly, and we're going to pay you 50% of your guaranteed compensation for not showing up." So, in that little bubble of what you think but you don't say, I think, well, 50% sounds half fair. I don't know how that sounds fair. But my contract, which was all Wall Street contracts, is you have a guaranteed compensation as long as you are there on the day they pay bonuses. So now I'm really dead. I gave away a business. I'm now at this point a young guy, married. My wife is pregnant. I don't have any real money saved. Goldman took losses, but so did everyone else. So no one's hiring. So now I'm going to be this unemployed married person, baby on the way, moving back to live with mom and dad in Brooklyn. So I'm pretty panicked. So I go to Goldman and I say, look, this is a bad deal for you. You're going to pay me half my guaranteed total compensation not to show up to work. Why don't I just come and I'll work for 6 months? And at the end of 6 months, no harm, no foul. If there's no role for me, yeah, I'll leave. But if you're paying me to work for a half a year, let me work. And I said, this is brilliant. How can you say no? And they say, no, doesn't work. It's a headcount issue. So I go, okay. Now because I went through these 10 rounds of interviews, I had been in Goldman offices a lot. And I got to know the receptionist at the front desk. And it was this young woman. She was an actress, a writer, typical New York. And she was a temp. And she did temp receptionist between acting gigs. So I literally went to her and said, who's your temp agency? Can you make an introduction? So now I call this temp agency, and all they do is administrative people and receptionists. And I say, look, I have a job. I'm going to make this amount of money, but I can't go on their head count. So I want you to bill them, they to pay you. I'll be a temp. How much will you take? And you need to do nothing. You don't need to place me. I have the job. And my comp was going to be clearly a lot more than the average receptionist. So I cut a deal with them. And then I go back to Goldman and I said, problem solved. I will come as a temp. I'm not on your head count. The temp agency is the same temp agency that this young woman is using. So it's all in Goldman's system. And at the end of 6 months, no job for me, no problem. But if you don't do this, you got to wake up in the morning, look yourself in the mirror and say, we really screwed this young man, right? He did nothing wrong. He didn't blow up 200 million in the macro fund or whatever. And they begrudgingly said, fine, like they're doing me the biggest favor. But I put on the game face, thank you, I appreciate it, love you guys. And that's how I got my start. And went to Goldman, did well. And then after 4 years, Bob and Ed, and remember, these are the guys who called me and told me not to show up, left. They were extremely wealthy, pre-IPO partners, and they were launching their own hedge fund. Silver Point Capital, it started with 120 million. I resigned and I joined them, and that's my story. So a little more than you probably wanted, but it's inspirational. And that's what I think. I'm an inspirational human being because I overcome adversity. And a little bit of people say, this moron could make a lot of money. Anyone could do it. And that's why America is great.
But I also feel like so much, and we spoke about this yesterday in the pre-call, that like so much with distressed debt investing is like the negotiation.
Yes,
so it's
absolutely.
like figuring out how to do. So it feels like that actually almost demonstrated that you had the skills and the intellect, not just to be like, oh darn, like I didn't get this job. It's like, let me figure out how to actually do it. And I also thought
100% agree, and I write that in the preface to my book. I have now been involved in either directly negotiating or through people that now reporting to me some of the largest, most complex restructurings. But in my mind, my best and most important negotiation was those early days when Goldman told me not to show up.
Yeah, no, absolutely. Well, so let's get into it. So what is distressed debt investing, and how does it differ from, say, other more common asset classes?
Yeah.
Value equity, private equity, or even just being a credit investor? What does it mean to be a distressed debt investor?
Yeah, it's a great question. And 10 years ago, I started to go back to teaching as an adjunct professor at Columbia Business School in their value investing program. So one night a week, I go there and I teach. And Columbia, and this will get to your question, Columbia always was about value equity investing because Warren Buffett went there and they got to milk that relationship for as long as they can. And I came in and within that program was going to teach a course on distressed debt. They called it DVI, distressed value investing. So the first day I'm teaching, a student asked that exact question, said, look, we've been trained how to be a value equity investor like a Warren Buffett. We've been trained to go to work for a private equity firm like a KKR or a TPG. What does it mean to be a distressed debt investor, and how does it differ? And I thought about it, and I told this story, and I think this story really illustrates the difference, or at least the perception of why distressed debt is different. Now, I've told this story a million times, so if any viewers have heard it, they can fast forward. But it really is a great illustration. So, true story. There was a company and it was going through financial problems, and its investment banker was hired to raise new capital to go into the business, to give the company the needed cash to hopefully turn itself around. So this investment banker reaches out to three very different types of investors. There's a value equity investor, there's a private equity investor, and then the third investor was a distressed debt, such as myself. Investor. And the investment banker explains the story and says, look, would any of you like to meet with the company? I could arrange full day, go through their earnings, their projections, why they got into problems. They'll spend as much time as you need to get comfortable thinking about injecting capital. So all three say, sure. So the company was in the middle of nowhere. They were going to get in a car together. They were going to drive, stay in the local motel, and then at 7 a.m. start the meetings and see if there was something to do. So they all get in a car. They have to get off the main highway, and their car breaks down. And there's no cell coverage. So they all agree they're going to sleep in the car. And then one of the three investors sees a farmhouse. So says, maybe the farmer will be nice enough and let us stay there. So they explain their situation to the farmer. And the farmer says, look, I have room for two of you to sleep in the house. One of you has to go and sleep in the barn, but the barn is going to be much more comfortable than the car. So the value equity investor says, look, I'm exhausted and I can fall asleep anywhere. You guys stay in the house, I'll go to the barn. So everyone goes their separate ways. 2 minutes later, there's a knock on the door. It's the value equity investor. And he says, look, I was okay sleeping in the barn. No one told me there's a cow in the barn. I'm not going to sleep with a cow. So the private equity investor gets annoyed and says, you know what? You're a crybaby. Sleep in the house. I'll go sleep in the barn. They all go their separate ways. 2 minutes later, there's a knock on the door. It's the private equity investor. And the private equity investor says, look, I was okay sleeping in the barn. I was okay sleeping in the barn with the cow. No one told me there's a pig in the barn. I'm not going to sleep with a pig. So the distressed debt investor, such as myself, looks at both of them and says, you know what? You're both crybabies. Sleep in the house. I'll sleep in the barn. They all go their separate ways. 2 minutes later, there's a knock on the door. It's the cow and the pig. I usually do this massive auditorium. I let the laughter die down because it's a hilarious story. But it illustrates why distressed debt at least has the perception of being different. It is investing.
Yeah.
80% of the skill base is identical to any other type of corporate investing. Analyzing the industry, having a view, is it a good industry? Is it growing? Is there risk of disruptive technology? Then understanding the business, ripping apart the financial modeling. 90% of it, 80% of it is identical. But then in certain situations, not all, a big part of it is some of these companies, not all of them, will go through a bankruptcy. And in that bankruptcy, there will be some confrontations. The confrontation is there's going to be a lot of different layers of debt and who gets what. And as you talked about in the beginning, part of that is negotiating it. Part of that is driving the bankruptcy process, understanding the bankruptcy code, all of the legal frameworks. And with that, at least the press likes to call us vultures, grave dancers. But I find that really hurtful. That's a really hurtful statement because we're really not. When you think about it, we do much more good than harm. One, in a lot of situations, we believe the company will survive, can avoid bankruptcy, and we're in there working with the company to get them more capital to avoid a bankruptcy. And we are really, really well received by the company, the private equity sponsor, because we are helping solve a problem. And people sometimes refer to that as capital solutions lending. You are solving a problem. But in the cases where it's hopelessly over leveraged, there's a industry-wide problem like retailing, and the company is going to go through a bankruptcy. Some of those situations get confrontational, and you got to be comfortable driving the process. But even in those situations, the distressed debt funds are adding a lot of value. They're in there, they're buying debt, they have a seat at the table, they're working with the company, they bring in the best restructuring advisors so the company could utilize the bankruptcy code to fix the business. In bankruptcy, you could reject assumed leases. You can't do that. You could renegotiate union contracts. You could do a lot of things to fix the business. And then upon emergence, you could discharge debt. You could start out with $1 billion of debt and say, the company can't be viable, can't grow, can't hire people, can't contribute to society if we exit with the exact amount of debt. We're going to exit with significantly less debt. And some of those debt holders are going to end up getting the equity, owning the business, and becoming effectively the private equity sponsor of that business. And in that, some layers of debt might get no recovery, out of the money warrants. So you got to get comfortable that you got to be able to drive the process to protect your investment. But I argue most of the time, the distressed debt investors are adding a lot of value. So, if you're watching this and you're taking notes, you could say some people call us the villains. Some people call us the heroes. We are clearly the heroes. If you're taking notes, write this down. Michael Gatto. Michael Gatto is my hero. Exactly. So you guys are quick learners.
I mean, it's so funny because reading the book, it was so much at the beginning is all the stuff you learn in basic investment banking, private equity training, right? It's all the fundamental valuation analysis, everything you talked about.
Let me stop you there.
Okay.
The first part of the book is the basic learning on steroids, one, much more than any basic, and two, I make it interesting.
Yes.
Even the basic stuff.
I'm not trying to insult. I'm not trying
Kristen,
to insult
you
it by
didn't
saying
sell
it's
that
the
book.
same.
No, you didn't sell it.
Sorry.
You were like, let's go on a replay. No.
Sorry.
It's on video. We could replay it.
Let me
Finish. You'll have your turn. You basically said the first part of the book is basic. It's elementary. And I took issue with that, as I should.
Sorry.
Thank you, Jen, because Jen had my back. Jen stopped up and said, no,
Don't
that's
pit us
correct.
against each other, Mike.
What I'm trying to say is that you have to be an expert in so many different things. So the point is that, like, you not only have to be an expert in what you need if you were to go into investment banking or private equity, but also understanding the bankruptcy proceeding, understanding all of the potential pitfalls with some of the, creditor-on-creditor violence. Some of the stories that you put in there about, like, Jay Screwed and the CERTA and the credit default swap.
And it's just got him on steroids today.
Yeah. But it seems like not only do you need to be an expert across all these different things, like it's like being the sort of investment private equity thing is not good enough. It's bankruptcy expert. It's actually like seeing some of these deals. It's knowing where some of the pitfalls are, and almost like having the elbows, because it seems like there's a lot of people in there who are going to make sure that they get their pound of flesh in, like, that bankruptcy proceeding. You talk about in the restructuring chapters, going through with chapter 11, there's no one clear-cut thing. One person's going to say the valuation is this because it's going to be better for one tranche of bonds. And then another one says, oh, it's this different valuation because it's better for another. I guess one of the questions that I have is, A, can you talk a little bit about that so our listeners know a little bit what I'm trying to say here, because you obviously explain this for a living, but also, like, how did you learn all that?
Yeah, there's a whole lot there. So let me break it down into things. One, I agree with. How I always describe it is, if you're going to be a credit investor, you will learn more. And I'll get into distress in a moment. I'm saying credit, private credit, commercial banking credit. If you are lending money to a company early in your career, you will learn more than being a straight equity investor, because it's more complex. When you're an equity investor, all you know is all the debt comes ahead of me. I only get value if the debt is par. You don't learn all of the nuances why one debt instrument is good, one debt instrument of the same company is not as good. So I always argue, and this I really believe, if you have the opportunity early in your career to do credit, do it. You will be more valuable to the market than just doing straight equity. Mm-hmm. That's one. Two, then you go to distressed credit, and your learning is so much more, because one, becoming a master of the bankruptcy code, and if you're at a big fund like Silver Point, you're doing this around the world, going through a bankruptcy. I drove Novacap's restructuring. That's very different. A company headquartered in France under French law versus the U.S. versus other parts of the world. But you learn another skill base. So all of this is tremendously valuable. And when you're young, your whole mission is, how much did I learn today? Mm-hmm. What you make is completely irrelevant. If you wake up and you're an old guy like me, 58, and I'm thinking about what I made my first 5 years out of college or out of business school, my career went terribly wrong. You're playing the long game, and the long game is learning. So I believe you learn tons in credit and even more in distress. Yeah. Distress is hard to get into. It's very narrow. So I focus on LevFin, restructuring advisory. Don't get too caught up. I got to get into here, because everyone who reads the book says, oh my God, I want to do what he does. Yeah. You don't have to. I didn't start there. I started at Citibank. I was going to do commercial lending. So that's part one. Part two is, how do you learn? You learn by reading. Like, there's this book. I don't know if you heard of it, The Credit Investor's Handbook. You could go on Amazon. You read that book, you learn. But You also find a mentor who's going to teach you. And that mentor could be people that's associated with Wall Street skinny. They introduce you to, they have a consulting, come in, we'll get you 15 minutes, a half an hour. You get mentors. You get mentors by where you work. The most important thing when you get to a full-time job, who is your mentor? Who is your rabbi? You need to find the people that genuinely care about you learning. Now, it's a two-way street. You got to run through a brick wall for that person, but that's how you learn. And then look, when you do it for 30 years, you become the expert, right? I don't have a legal degree, but I'm out there teaching liability management. I'm sitting on panels with the best lawyers in the world. I sat on panels with sitting judges. And without stroking my old ego, because I don't need any stroking, I know how great I am, everyone is turning to me to explain these concept legal or nuances. Why? I'm doing it. I'm a practitioner. But I also read everything that's out there, and I ask questions. I read an article by one of the world's best lawyers in this, and pick up the phone and call him or her and say, I don't understand what you meant. Walk me through it. There was a quote I read last night, which is, as a young person, just ask questions, but know when to shut up. And what that person said is, read your audience. Like, you come in, you're working for me. If I'm stressed, if something's blowing up, read it and say, this isn't going to be the time to pound them with 20 questions. Keep a notebook. I read this, I didn't understand this, and then try to find those moments you could pick someone's brain. And that could be services like you provide. That could be people in the organization. That could be alumni. Life is about networking. The one thing AI cannot replace, and it's going to replace a lot, human connectivity. It cannot replace in the near term. In the long term, people think you're going to fall in love with the perfect soulmate who's not going to be a human being, which is going to be a computer.
God, Michael,
but that's going to happen much later.
Dystopian vision, we're not ready for that now. And you're
but that's it. But for now, connectivity is critical. I don't know if I answered your question because I talked so long, I forgot what I was talking about. And then I went into the robots are taking over.
Well, I will say, sorry, one quick thing, because I know Jen has a question, but I will say yesterday we were, like I said, we had this call and you made a comment how, I do think there is this mindset amongst credit and fixed income people, because Jen was laughing at me because you made this statement. You said, I would be a terrible venture capital investor because you have to be so much more positive if you want to be in the equity investing space versus credit. You're basically who's trying to screw me? But Jen has had this view on the robots are taking over and we're all screwed. It's are you a doomer on the AI thing versus are you optimistic? So it totally tracks that you're pessimistic on that because it fits with the whole mentality.
Every credit memo, when you're a credit, I'm going to address a point
and
you
a memo,
just made.
dear listener, for the infants among us.
What is the credit memo?
So let me. When you're a credit investor, you are the person that the glass is half empty. It's very different than a venture capital. A venture capital is I could do 10 deals and get zeros on 6 of the deals. What I can't do is miss the next Facebook, the next Anthropic, the next whatever. When you're a debt investor, your mindset is, I can't make a mistake. I have to be paranoid. And so you do have this glass is half empty attitude. With that, we look at every new investment we're making. non-distressed, the new loan in the private credit world of where you are lending a company or private equity sponsor money with the intent of clipping a coupon and getting paid back at par. Every deal we go through, there is a section of the memo that we discuss, is this a business that's vulnerable to AI? Mm-hmm. If so, what is the timeline of that vulnerability and how bad can it get? Because today you can look at a credit and it looks great. It's the company's producing enough cash flow to easily make your coupon. It's sitting in there. It's got a long track record, but all of a sudden, can AI come in and hurt this business? And you got to discuss it and you got to debate it. And it's new. We've never seen anything like this before. So part of being an investor is pattern recognition. You do it for 30 years. You say, that reminds me of this transaction. If the economy goes into a recession, these companies are going to go down, but if you support it, they're going to go back up. These are the companies that are going to end up disappearing. Lend to company A, not company B. You have a lot of pattern recognition because you've seen so much and you've seen it through multiple cycles of ups and downs. AI is very new and it scares me, and it should. If you're a debt investor, it is unhealthy. The thing that would get me the most nervous is when we or my boss, Ed Muley, and Ed Muley is the best investor I've ever met. I've been riding that guy's coattails. I said, this guy is amazing. I'm just going to ride his coattails for as long as I can. And I have for 28 years. But the thing that would get a guy like Ed the most nervous is when he says, are you worried about that? And someone says, oh, we're not worried about that. The answer is yes, we are very worried about it. Here's the risks, but this is why we think these risks are manageable. But the minute people say, I'm not worried about it, I don't think AI is a big deal, they're gonna blow up. Maybe not tomorrow, but those funds are gonna blow up.
Okay, so backing up like 15 steps, you talked about liability management exercises, creditor-on-creditor violence is obviously a huge theme that's emerged in the past few years. I want to get into all that, but before we do, you've given some very noble advice about the future and about career management. I want to know how you make money. Because to the unseasoned ear, it may sound like you just talked about clipping coupons. You just talked about risk management. Are we just buying bonds at 75 cents on the dollar and redeeming them for par? Like, what are some of the strategies that you actually use to make money in distressed debt investing?
Well, I want to take it a little broader, and then I'll get into distress. Silver Point Capital makes money both by investing in performing loans and distressed debt. We have multiple different types of funds depending on what our investors want. If you're an investor in performing debt, then you could be either buying debt from the broadly syndicated loan market, where a Jefferies, a Goldman, a JP Morgan, a financial institution arranges a loan to either a company or to a private equity fund buying a company. They do all the upfront work. They find the deal, they structure it, they negotiate it, and you're just buying a small piece of their deal. That's the broadly syndicated loan market. And in that, your whole mission in life is to buy deals that pay you the coupon and refinance you out or pay you out at maturity. If you've done that business well, it is boring. It shouldn't be exciting. It's a great career and you learn a lot about companies, but you don't want defaults. Then continuing on performing loans, the second way is saying, I don't need the banks to find the deal, arrange it, and I just buy a small piece. I'm going to do all of it myself, and I am going to be the lender. So the company is going to view me, and that's what's called private credit. So huge, 16, 17 billion of the 41 billion that we have our investable capital is private credit. We're going, negotiating the loan. We get an upfront fee, then we get our coupons, and then we get taken out. Similar mindset. Underwrite good loans. You don't want problems. But the only difference from the broadly syndicated loan market, you need people to find the deals, you need to negotiate them, and you need to be big enough that you could write $200 million check, $500 million check, because one of the reasons they're going to you, not the broadly syndicated loan market, is they don't want to deal with 100 different lenders. They want to know I am dealing with Silver Point Capital or someone else. You have a question before I go into distress?
Yes, really quickly on the public investments that you're making, are those set up as like CLOs in the sense that, and that's how you're doing it? Just this is more like getting in the nitty gritty, but
yeah. The buying broadly syndicated loans, the way most funds do it is they set up what's called a CLO. And all that is a legal structure of how you're buying it. And then you have banks that set up debt for the CLO. So the CLO has equity, and then it has debt, and then it's using all that capital to buy those loans. And that's how 60 or 70% in that range of every broadly syndicated loan is being bought by non-banks in structures called CLOs. Okay. So yes, in the private credit, it's not a CLO. It's a regular fund structure.
Awesome. Okay, continue. I just wanted to make that
component for us is distressed debt. And distressed debt is a lot of things. In my book, I have a chapter on all the different ways, strategies we make money in that arena. But big picture is someone else lent a company money. Whether that was 5 years ago, 2 years ago, the company did not perform the way people thought it would, and that debt is now offered. You could buy it not at par, not at 98 cents on the dollar, but at a material discount, whether that's 80 cents, 70 cents, 10 cents, it depends. So now you're buying that debt on cents on the dollars. Then how do you make money? Big part of the debt we buy, we don't think the company will file for bankruptcy, has to file for bankruptcy, and the bet we're making is what's called pull to par, which means we're buying it at 80 cents, we're going to clip a coupon, the company is going to do fine, and we're going to get paid out at par, but we're going to earn a much higher yield to our investors because we didn't buy it at 98 cents on the dollar par. We bought it at 82. So that's one strategy. Another strategy is what some people call distress for control. That's where we're buying the debt. And we know either the company is in bankruptcy or it's clearly going to go into bankruptcy. And we're making the bet that our debt will get converted into equity because when the company emerges, it's never going to be able to support the level of debt it had. And we're actually saying we're going to end up owning this company by buying the debt at whatever it is, 60 cents on the dollar. And it will go through a bankruptcy. And when it exits bankruptcy, we'll convert some of our debt. And I write about it in the book, all of these strategies, but one of the examples I write was Men's Warehouse. Men's Warehouse owns
Joseph A. Bank?
It owns Joseph A. Banks and other brands in that retail. And during COVID, the senior secured bank debt traded down to 30, 40, 50 cents on the dollar, depending when you buy it, because all the stores were closed. It was burning cash. A huge portion of their revenues are tuxedo rentals, which is a massively profitable business. A young person's getting married, their wedding party goes and rents these tuxedos. The return on capital is staggering, and they dominate nationally that. And the debt was trading, which we thought was below the liquidation value. We thought we could buy this debt at this price if COVID didn't end and you had to just go and liquidate the owned assets between the inventories, between the owned real estate. We would get back our cost and a little profit. But the big play we were making was we were seeing the end to COVID. We would convert our debt to equity. We would inject some more liquidity, and the company would turn around and produce a massive amount of cash flow because of all the pent-up demand. Weddings were going to happen. That rental business was going to go out of control. Every day, they are mostly men's clothing. Everyone was going to eventually go back to work. Everyone either got fat or got in shape. But with like a crazy amount, no one could fit into their own clothes. You could be someone like me. COVID happened and you sat home and you ate a lot. You drank 10 times the amount of alcohol. And when we got back to work, none of my clothes fit. Or you could be the person who went out, bought a Peloton, worked out like crazy, and got into shape, and none of their clothes fit. Either way, and we made that bet and it all worked out. So those would be the two extremes. One is you're buying it, you think you're going to be pulled apart. One of it, your intent is I'm going to end up owning the equity. And then there's all strategies in between, including playing liability management, capital structure up, where there's two bonds and they're trading pretty much on top of each other. But you're like, this bond is better than this bond. I should long this, short this.
What makes it better? How do you determine when looking at two bonds that are trading pari passu or that they're trading on top of each other in the market?
Yeah, it's a great question. It's like, think about Lehman Brothers, Enron. These were massive companies that had hundreds, if not thousands, of different bond issuance. Every bond is a contract between the owner of the bond, basically the lender, and the company, the borrower of the money. It's a contract. It's a bond indenture. The bond indenture sets every aspect. Which entities guarantee the bonds? How is it structured? So now you have the buyer of these bonds, when everything is going well, or investment grade mutual funds that don't do an inordinate amount of work. They rely heavily on credit rating agencies to say, okay, Lehman Brothers is a single A company. Probability-wise, single A companies don't default quickly. They get downgraded, they get downgraded, they get downgraded. We don't need to know every little nuance of every bond indenture in Lehman Brothers because it's a single A. It's just not going to matter. We're buying this to get the coupon. Then 2008 happens, and a Lehman Brother goes from investment grade to defaulted. bankruptcy, and then ultimately a liquidation very quickly. All of those little nuances matter. And then you have certain bonds, which I write about in the book. It's very technical, but I think I do a reasonable job of explaining it. There were certain bonds in Lehman Brothers that had what legally people call a double dip claim, meaning the bond would get two recoveries from Lehman Brothers. Again, I'm not going to explain why. You could read the chapter on it. It's just too intense without a whiteboard and all that. But another bond was not entitled to the double dip. Now, Lehman files, most people don't understand what a double dip is, haven't analyzed it. Getting the right lawyer to look at it is hard because every law firm is conflicted in that they're representing Lehman, they're representing the unsecured. So if you have the right access to the right lawyers, you yourself understand this, you could spot where one bond is clearly in your mind. It's going to get litigated as Lehman got litigated, but in your mind, you're like, this is obvious. This bond is better than this bond. And in Lehman, there was huge fights over whether the double dip bond should get a 2 times recovery of the quote, quote, other bonds, the normal bonds. And the answer was yes, because it all got settled. And I believe, again, it's in the book, they got a 1.8 recovery. So it was agreed that no one would litigate at a 1.8 recovery, so it never had to go through a whole trial to have a judge determine it. But if the other side agreed to 1.8, you knew that it was much more likely you were winning that case, because why would they settle at such a high recovery? Did that answer your question?
Yes.
And there's tons of little nuances. Yeah. And liability management exercise, which I teach, that's a 3-4 hour lecture.
But what is a liability management exercise in 3-4 minutes?
Is that the creditor-on-creditor violence?
Yes. So I did a podcast for Bloomberg, and I said I love liability management, and some people took offense, like it's an evil thing. And what I meant by that is I find it interesting. It's new. I love talking about it as a teacher or as an adjunct professor at Columbia and Fordham, but also as an investor. But I'll give you an explanation on one of many. Let's assume a company is getting acquired by a private equity fund. And how they're going to finance this acquisition is a bank is going to raise them $2 billion of senior secured loans, and they're going to put $1 billion of equity. So they're going to buy the company for $3 billion. $2 billion is going to be a loan that is broadly syndicated, meaning one of the banks arranged it and then sold it out to a bunch of investors, predominantly CLOs, as we discussed earlier. In the old days, anyone who bought a piece of that large $2 billion broadly syndicated loan thought of themselves as the Three Musketeers. One for all for one. If I, Michael Gatto, and you, Jen, bought a piece of the exact same debt, it is money being borrowed by the same company under the same loan document. It's one for all for one. If I make money, you make money. If I lose money, you lose money. That's the mindset. In creditor-on-creditor violence, one set of owners of the exact same debt does better than the others. And you say, how can that be? It's the same exact loan. So there's all these different scenarios. I'll go by the one called up-tiering. Now, let's say, Jen, me and you, we own the exact piece of debt on this LBO.
Yep.
The company starts to underperform, and they desperately need another $200 million of new money so they could use that liquidity to turn around the business.
Yep.
Our loan doc, the broadly syndicated loan, says unambiguously that company cannot borrow another penny senior to our debt, ahead of our debt, or equal, pari passu to our debt. If they need to raise more money, it has to come in junior to protect all of us that we lent, saying we are first in line if there's a problem. Now, every loan document can get amended by a 50.1% vote, sometimes 2/3. But loan documents can get amended if more than half, whatever's the requisite lenders, agree to it. So now a majority of the owners of these broadly syndicated loan says, we're going to amend the doc to allow you to borrow $1,200,000,000 senior to the existing loan. Mm-hmm. That's a lot. The existing loan is $2 billion. Now $1.2 billion is allowed to come in ahead. Now, Jen, you say, I'm no worse than anyone because they're amending the doc. So everyone is hurt equally. But that's only step one.
Yeah.
Then step two is the majority who agreed to that amendment makes the $1,200,000,000 loan. They put in the new money. Of that, $200 million of it is for the company to turn its business around. The remainder, they then turn around and buy our debt at a discount, not at 100 cents on the dollar, but it could be 95 cents on the dollar at some discount. So now my old debt is done. I got, let's say, 95 cents on the dollar. Now all of my new debt is senior. Mm-hmm. You wake up and where you were part of a $2 billion facility that was first in line, you are now part of a $1 billion facility that is junior to $1.2 billion. Your debt trades from, let's say, 85 cents on the dollar down to 30. That is one example of a liability management exercise, which the
what
press...
What a sanitized way to
I know.
This
should just become screwing the other people who are here.
That's the creditor-on-creditor violence. And there's all variation. You know, Jay Screwed was a different... Cerner is what we're talking about. All of this gets litigated. Like, were you really allowed to do it? And, you know, Cerner is still going through appeals.
Really?
It was done. One judge, Judge Jones in the Southern District, said, this is unambiguously allowed to happen. The minority lenders, sit down, shut up, stop your whining. Didn't say it that way, but that's how it was translated. This is happening, and in fact, the company exited bankruptcy with the recoveries being based on the new money being ahead of the old money. Then Judge Jones resigns in disgrace, nothing to do with Cerner, but it's interesting, so I'll bring it up. Judge Jones was having a romantic relationship while married, even though I'm not judging, you know, but with a lawyer that has argued cases in front of him, and that's a clear conflict of interest. So Judge Jones resigns in disgrace, but after Cerner exited bankruptcy, And then the Fifth Circuit on New Year's Eve said that transaction was not allowed to happen because it relied on this provision called non-pro rata market purchases, all explained in the book. But it's now, the Fifth Circuit is now being appealed, and it's a mess. But that is an example of liability management. And you could Google EchoStar. They were doing it. We were very involved. There's been a lot of press on that. But understanding this and knowing when they can do it, and you shouldn't be crying about it. You should have known that you were vulnerable to it, is very important. And also knowing when they're doing something they should not be able to do, but now the debt has traded down 40, 50 points, and buying it and saying, this is going to move back up. Some of this is a fear of something happening that will not happen. And, Bausch and Lomb, I felt, was that way. We were very involved of buying the debt. The bonds that were senior secured bonds, people were very fearful they were going to be the victim of a liability management relative to the term loan, and buying those and then making a judgment. What people feared that brought the bond price down would not happen. So there's Serta, there's J. Crew, Dish, which was owned by Charlie Ergen, part of EchoStar. It's going to all be in addition, too. Right now, I can't write about it because we're either involved, there's still litigation, but I've already, in my mind, have written 80% of addition, too.
Cool.
Because all this stuff is new and interesting.
Yeah. I was going to say really quickly, I'm always like thinking about where words come from. Like, because when I first heard liability management, I was like, what the hell? But it makes sense because it's like, if you are the actual company, you're trying to manage like your liabilities. Yeah. But then if you're on the other side, because there's the two parties, it's like from the perspective of the creditor who's lent the money, they're like, well, this isn't fair. And
that, like, there were three names to it.
Oh, what was the third one?
There was liability management exercises, which is the name all the lawyers use.
Of course.
Then there was creditor-on-creditor violence, which the press used because it's sexy. Violence is good, not in general, good for selling papers. And then one of the law firms that designed a lot of the early LMEs, liability, tried to call it PETs, position enhancing transactions. So taking like the positive, that never caught on. No one has ever used.
No.
Yeah, the position enhancing transaction.
In the
seriously,
bubbles gone by.
Well, I'm curious. So a couple of things, and this is, sorry if this is like a slightly longer question, but I'm curious why, because I'm guessing this was not as common, call it 10 years ago. And in the book, you talked about how kind of as a result of the ZERP environment where people weren't able to get yields, you talked about covenant-lite loans, like they were willing to accept more lenient covenants. And then also from the perspective of the company, more friendly terms for them. So is that part of it?
Yeah.
/ do you think that this is potentially going to impact, say, CLOs? Jen knows this. There was someone on social media on Instagram who was like, the last credit crisis was all the ABS, mortgage-backed securities, blah, blah, blah. This one is going to be CLOs. And I literally commented, I was like, you do understand that CLOs were around in 2008. I was working on the CLO desk, but defaults were like 2% and they did amazing. But I'm curious, because of some of this, do you think that potentially like this time around, there actually might be merit to that because of just the way some of these people can get like Jay screwed or what have you?
Yeah. No,
and also the fraud.
Yeah. So the first question, and the fraud is a whole different topic that we might or might not get to. But why did this happen? And when I wrote edition 1, I wrote a chapter and then I sent it out. And if you commented on it, gave me suggestions, it was clearly no good deed goes unpunished. Then I sent you the next chapter. But a lot of people said you're making too big of a deal on liability management exercises. They're going to disappear. It's almost a fad. And I said, I disagree. And as usual, I was right and they were wrong. But why? Why did it happen? Because 30 years ago,
This was nothing.
Yeah. Part of it is there's a cultural change. After 2008, I think the equity sponsors said, we have to do everything in our power to protect our investors, even if it's at the detriment of lenders. So there used to be a little bit of this pride that no senior secured lender ever lost money with us, being a private equity sponsor. Then that no longer was the case because 2008, no fault of anyone, was a shit show. So a lot of people did lose money. So I think there was a cultural element. Two, I think the private equity funds are commercial animals, really, really smart people. And they started to talk to the smartest, best lawyers and said, what if things go wrong? How can I, if they go wrong, get in more money? And they started to build in all of these little things in the loan document that
This little
were,
comma. Don't pay attention to it.
a little bit of that. All these things that were clearly to the benefit of the borrower, not the lender.
Right.
And they're smart, they build it in. And if you are the lender, you agreed to this. Now, I think in the beginning, there were a lot of lenders that did not know what they agreed to, especially if you're a small CLO and there's $1 billion deal and you're looking to get a $5 or $10 million allocation. You're not going to read the 300-page document. You're not going to call the company and say, change this provision or I'm not doing the deal. Because they're going to say, I don't care if you do the deal or not. I'm doing you a favor by giving you any allocation. So I think in the beginning, there were real shock. And as I said, also, all of the lines were being tested. So everything was a litigation and some got settled, some are ongoing. But now this has just been part of the docs. And the reality in the broadly syndicated, and this is much more a broadly syndicated loan than a private credit issue. But if we're in a part of the cycle where there is so much capital chasing deals, the documents are going to be more borrower-friendly than lender-friendly. And this is going to be part of deals for the foreseeable future. Now, you as the investor have to understand that. If you're a small CLO, this is going to be really problematic. Because if there is a creditor-on-creditor violence, there in the certer, in this, assuming these hold, some of the lenders position was improved. Some of the lenders were hurt. If you're on the right side of those trades, especially if you're a distressed debt fund and you didn't buy the debt at par, you bought it at 60 cents, and then you cut a deal that you're going to take a discount, but you're going to get 85 cents of new money ahead of everyone. That's going to be par in your mind because it's coming ahead of everyone. And even though you took a discount on the face, you didn't buy it at face. So you're going to have funds that yields and returns to their investors are supercharged, but you're going to have other funds that are hurt. And when this cycle turns, which it will, I think recoveries on some of this debt is going to be much worse because you think you're senior secured, that when you're going back to 2008 and say CLOs did well, but part of that was they were senior secured. So when something went wrong, all of the unsecured liabilities and all of the equity took the pain before they were hurt. Yeah. And they were clipping coupons. So if they had an impairment, usually the severity of loss wasn't that high. That might be very different if you wake up and you thought you were senior secured and there's $1.2 billion of debt ahead of you. Or there's a J. Crew where there's a provision that says I could move assets away from you. Well, if there's a provision that the borrower could move assets away from you, they're going to do that. Know what you agree to.
Yeah. So, Michael, you talked about where we are in the credit cycle, or rather, you talked about the credit cycle. Where do you think we are currently in the credit cycle? Every headline you just talk about, I think one of the reasons that the press uses the word creditor-on-creditor violence is it sounds sexy and it gets more people to read. Every headline I read right now sounds like doom and gloom for the credit markets. Yet pricing doesn't appear to be that way. And in your book, you talk about the benefit of being somewhat of a contrarian, if you will, being someone who keeps cash on the sidelines and keeps dry powder waiting for the right moment when everyone else is exuberant, and about being someone who's brave enough to know when to invest when things feel like they're bottoming out. Where do you think we are in that broader cycle right now?
Right now, we are in the extremely, extremely competitive part of the credit cycle. What I mean by that is a plain vanilla deal, like a leverage buyout where a sponsor is buying a company for $1 billion and is looking for 550 million of loans. It is very, very competitive. So, as you said, spreads have tightened, meaning you're earning a lower coupon, and documents have shifted from less protections to the lender being much more borrower friendly. So look, that's where we are. Now that's impacting both the broadly syndicated loan market and the private loan market, the direct lending market. What I think is we see every deal. You know, we're a big fund, we play in this. There are deals that are extremely good risk-adjusted returns. You are getting compensated well for the risk. There are what I would call fine deals. You're adequately getting compensated for the risk. And there are bad deals where you are not getting compensated for the risk. In the normal part of the cycle, when it's not overheated, those third layer of deals don't get done, or very few of them get done. They die. The company goes out, they're trying to do this, they're trying to do it on this terms. And people look at it and say, nah, and either it gets restructured to be a better deal, or they just can't raise the financing. In this market, I'm seeing all three types getting done. So what's going to happen is when the cycle turns, whoever's doing the bad deals, or too many of the bad deals, will cease to exist. I don't think it's a controversial statement. Anytime our asset class grows and you get to a supply-demand imbalance, bad deals happen. I don't think all funds are going to blow up. I think there's going to be three categories of funds. One category are the funds that have lived through multiple credit cycle. They've seen it. They've gone and punched in the face. They understand when the world turns, which deals are going to be fine. You need to do a little bit of tender loving care, lead in. You're going to do some amendments. You might increase capital, or the equity will increase capital. But those deals, you as a lender are going to continue to support. You're going to be somewhat accommodating, but get paid to be accommodating. So you end up going to get back all your money and get a higher yield because of all the accommodation and fees associated. You're also going to know which deals are concerning, and you're going to go quickly into de-risk mode.
Yeah.
And you're going to minimize any potential loss. But most importantly, because you have the workout expertise, because you are confident and you know where your problems are, you're going to continue to lend when everyone else stops. When you're lending in 08, 09, when you're lending when the world goes from fear of missing out to fear, you get unbelievable returns on those new deals if you know what you're doing. So I think there's going to be a set of funds that not only with their existing portfolio end up doing well and might even do better than it underwrote because of amendment fees, but just as importantly, they are going to continue to be in business when a lot of people aren't, and they're going to massively outperform. Then you're going to get the funds that were pretty good underwriters, don't have the right workout people, and they're going to basically shut down temporarily while they get their arms around workouts. Because when you hit a down cycle, even good loans might be in a workout.
Yeah.
But they're going to do fine. And the third set of funds did bad deals. They never lived through a cycle. They were run by younger people that maybe were more marketing, relationship, less credit, and workout focus. And those funds are going to have real problems, and they'll get very poor results for their investors. They won't be able to raise the next fund, and they'll just disappear. So that's what will happen. Then the question is, will that drag down the economy?
Right. How systemic is that level of risk?
Right, and that's
everyone's
where
getting into private credit, right?
Right.
And it's people who have never seen a downturn, Michael, who don't have our gray hairs and years of experience, but who were born long after the 1998 crisis you're talking about, and were in elementary school.
See, I argue the press and some banks are private credit is going to blow up and it's going to blow up the economy. I fundamentally 100% disagree. Like, not even close. Like, usually I couch. So then if I'm wrong, I can say, no, that's not what I said. This snippet. I
You're
used
all
the
in
word.
on this. Why?
No, I'm all in on this because private credit, for the most part, there's my little couch. Private credit, for the most part, is great for society because when we hit a hiccup, banks stop lending. When banks stop lending, if someone doesn't fill that gap, you then compound the problems and we go into a massive downturn. That's what happened in 08, right? Howard Marks, writes about this all the time. Now you have all these non-banks. They're not taking deposits. Most of them are using very modest leverage. So in other words, when they make a loan, they're lending, let's say, 60% loan to value, and they're funding it with 1-to-1 debt for equity, maybe on the higher end 2-to-1 for the most part. So one, if they go under, it doesn't bring down the economy. The government doesn't have to go and bail them out. But when there's downdrifts, these players step in when the banks don't. So look at 2023, right? Everyone focuses on we haven't had a cycle, ignoring COVID, which lasted 6 months, since 2008. But look at 2023. What happened is...
we had a little cycle.
Well, no, but that's my point.
Yeah.
But why didn't they get bigger? One, look at 2023. The banks got hung with Twitter. So the banks were now, they had done that at the end of 2022. In 2023, they still held the exposure. They were not able to sell it anywhere near par. So the banks started to take a more conservative approach. Then you had Silicon Valley Bank, an obscure bank no one prior to 2023 even talked about, went under, and other regional banks had problems. All of a sudden, the markets got nervous, credit tightened up even more. Then, at the exact same time, we started to see real inflation hit the economy, and the Fed said, we can't ignore this inflation. We got to increase interest rates. Again, I'm speaking for myself. In my mind, if you didn't have this capital in private credit, especially the larger, most sophisticated, saying, I still will do good deals, not bad deals, good deals, then even if these things become problems, these are companies that will survive. They stepped in. That is good for avoiding downturns when you have non-bank capital ready to step in. Also, if the ones who step in do bad deals, they're not going to get bailed out. If Silver Point Capital does a bunch of bad deals, we're not getting bailed out. God willing, we're not going to do that. But my point is, I think private capital, the direct lending business is good for the economy. But I do think some funds will underperform when the cycle downturn happens, and it won't be a big deal other than it will be a big deal for those funds. It will be a big deal for the investors in those funds, but it won't take down the economy. Yeah. And again, I might be proven wrong.
That was the most optimistic read from someone who, you're not paranoid if they're really out to get you. So that was, you're not.
No, and I think what I articulated is what will end up happening. I don't, if people say, is credit heated today? Yeah, absolutely. If you're not saying that, I don't know. You're not looking at the spreads. You're not looking at the docs of play vanilla deals. But I don't think this is going to blow up for everyone and then have a material impact on the economy. I think good funds will end up doing well, maybe even better than expectations, and some funds will cease to exist.
Well, and I feel like that's kind of what's supposed to happen. And so you had sent us this paper that you had written on First Brands, talking about just like people were not looking at the red flags. And I'd love if you can talk a little bit just about, like what you went through. And then something else that I would love just for our listeners to also, as we're getting into like distressed debt and like credit investing, something that I think is important was like reading the book, kind of the idea of value. I mean, this is not here, but like valuation fights and then structural subordination. Yeah. I thought that was so fascinating. So this is kind of a two-part question. Number one, can you just talk high level about this idea of valuation fights, structural subordination? Obviously, First Brands is going through a restructuring, a Chapter 11. So, TBD, I'm assuming that type of thing is going to happen. And then also how those two pieces work through in the bankruptcy process.
Let me address the First Brands question first and then the valuation fight, because First Brands is what we just talked about of overheated market flows very well into First Brands. And I did write a paper that your people could get here. I sent you a copy. Feel free if you have listeners who want it. They could reach out to me on LinkedIn and I can figure out how to get it. But
pause really quickly. Can we include a link to that in our newsletter this week? Okay, great. Okay. Well,
absolutely.
We'll include a link to our newsletter. If you guys subscribe to our newsletter, you'll see it from this week's edition.
So 30 seconds on First Brands. And if you're listening to this, you have to be following what's going on in First Brands and Tricolor. Some people it's spelled tricolor. These are two massive blowups that a lot of accredited investors are losing a lot of money. And now one of them, Tricolor, is in liquidation. It's going to turn out that there's fraud. First Brands, there's fraud. It's definitely being investigated. So they're very topical. But in First Brands, it is a company that was 100% owned by the founder who was the CEO, 100% owner. It is what's called the secondary market for auto supplies. So think your windshield wipers when you need to replace it. If you go to an auto zone, First Brands does that and a bunch of others things for a car. They grew by massive amounts of acquisitions, and they funded it with a lot of debt, and they went into the broadly syndicated loan markets over the last years, and it blew up. They were doing a normal refinancing. Debt was getting close to maturity, and they hired an investment bank to refinance the debt. And the existing debt owners, the people who owned the debt, all gave very positive feedback. Yeah, we're going to be interested in this, but they were looking to raise more debt than they had. And this started the process to stall as some more sophisticated new eyes looked at it. And then it went terribly wrong. They couldn't get the refinancing done. And the debt went from trading at high 90s, say 96 to par. It traded down into the 30s, and the company filed for bankruptcy. And it is a mess. It is a mess. It's going to be probably hundreds of millions of dollars of expenses to get this through a bankruptcy because there's going to be so much litigation. And the piece I wrote was, I know this company, the firm I work for, Silver Point, analyzed the debt. We had no exposure going into this problem, but I wrote an article. Could you have spotted these issues and gotten out of this debt before the problems? And there were a lot of red flags in the book, The Credit Investor's Handbook. Not sure if we mentioned it, but I wrote this book, The Credit Investor's Handbook. Thank you, Jen.
Every time.
In the book, I talk about spotting red flags, things that make you say, maybe this is more risky than I originally thought. And I make it clear, just because you spot a red flag doesn't mean it is a bad deal. It just means you got to dig a little deeper. You got to ask more questions. And First Brands, I think, is going to be the poster child of spotting the red flags and learning how to ask more questions. So I wrote this paper on it, and I got legal and compliance to say it's fine for you to send it out for teaching purposes, educating younger professionals, and that's First Brands. So that and Tricolor, go to the press, Bloomberg, Financial Times, everyone, Wall Street Journal is writing about it, and there's a lot of great lessons to be learned. So that was one. And then remind me, the second question was on bankruptcy fights.
Yeah, just like how valuation fights work and this idea of structural subordination. It's something that we were talking about last week, because just going through the Meta SPV where they were basically like utilizing project financing. And I was talking about how you can raise money at the project level, where it's a little bit different. It's not like Holdco Opco necessarily, but this idea that you want to be closer to the cash flows and the assets in terms of structural.
Yeah. And all of this starts to get fairly technical, but it isn't that hard. And so I write about it and I try to explain it. It's hard to do it on a podcast, but at the end of the day, as I mentioned, all debt isn't created equal. When you're an equity investor, because it's all ahead of you, you sort of don't get into the nuances. Each debt instrument is different, but these special purpose vehicles are designed, for the most part, to hide debt. If a company borrows and it gives its inventories and receivables as collateral, and let's say it borrows $100 million in a revolving credit facility, it draws it, it borrows it, well, that debt is clearly on the balance sheet. You see it as a liability. When you read the footnotes, it's debt. But some companies move the receivables and the inventories into separate legal entities, which are referred to as special purpose vehicles, SPVs. You'll see that all over. Then sometimes they structure what I think is effectively a loan, no different or not substantially different than that revolving credit, but they structure it in a way that the accountants are comfortable, based on GAAP, general accepting accounting principle, to remove both the assets, the receivables and the inventory, off the balance sheet and not have the debt associated it. And that's one of the red flags that I talk about in First Brands. How much debt was in this special purpose vehicles that was effectively hidden from investors, but with the right questions. If the company answered the questions, you knew they were there. And that's what happened with Enron. And I also talk about multiple books on Enron. And what I try to do is, when I explain anything, is then give a shout out to authors that have written.
Oh, there's a reading list embedded in your book.
Yeah,
in my book, and even in the First Brands article, and these are books that are written like novels. They're not textbooks. So there's books on Enrons that are fascinating, books on the great financial crisis. But so these things are complex. You can't cover them in a podcast, without a whiteboard, but you got to understand them and think about them. And that makes you more valuable. Like, I'm assuming your key audience for Wall Street Skinny is not the 20-year M&A lawyer.
You'd be surprised.
You'd be
surprised. That's about 50% of our audience.
Oh, so I stand corrected. But
usually it's people who want to understand something outside of their niche. So it's like they're working in,
well, that's fantastic. Because what I would say, all of these little topics, if you're going to be better, have more market value, you got to get deep in them. That's your competitive advantage. And that means reading, asking questions, as I said. Well, and this is the first time I've ever done anything like this First Brands thought piece. It's purely an educational piece, and I hope to do more. And clearly, if I do more, I will share it with you guys.
Awesome.
And you could share it with your audience.
Well, again, that's just a plug for your book, because you look at First Brands going through this restructuring, you talk about the valuation fights. I mean, different people can have different ideas about what the valuation of the business is. And that hugely impacts the ultimate residual value for these credit investors. And so that's, to me, just such an important takeaway, that it's like, you can be right about, okay, this was a good investment at the time. Then you go into this bankruptcy and you don't know what necessarily the judge is going to decide is the valuation that you choose. Like, your value that you pick could be not the one that's ultimately chosen. And then that has a huge impact on the actual value that you realize. So you go through all these great examples.
Let me give 30 seconds on that. Is let's assume a company has 500 million of secured debt, and then it has 200 million of unsecured bonds. You might be buying those bonds because you had 40 cents on the dollar, because you were saying the bonds deserve a recovery, even if that recovery isn't cash, isn't new debt, is equity. So you're saying there's 500 ahead of me, 200 of bonds, so there's 700 of debt, and you're making the bet the bonds will end up getting a recovery, probably in equity. And then you wake up and the judge says the company's only worth 400 million. There's 500 million of senior secured debt. So the senior secured debt gets 100% of the equity of the company after it emerges, and the bonds get zero. 2 years later, the company is sold for 800 million. And you're like, I was right.
Yeah.
I was right. There was value for the bonds, but you got a zero. And that's the thing. Not only do you need to be right analytically, you need to understand the bankruptcy process and what is going to get determined. Because if the judge says the value is this, and at that value of the company, the senior secureds deserve 100% of the equity of the company that emerges, you get a zero. And that's what's called a valuation fight. And in the book, I give a hypothetical that's very easy and fun to follow. And then I talk about real life situations that I've been involved in where the valuation fight is fought. Now, a lot of times you end up doing a negotiating settlement on what the value is. And so rather than the bonds get zero, they agree, okay, you get 90, we'll get 10. And the judge does not have to settle the dispute. But there is, in a lot of bankruptcy with complex, large capital structures, a fight. And if that fight gets settled, that happens. And if not, eventually a judge is going to hear from every party, and then the judge is going to rule on it. And that's, Michael, again, why it's a different asset class. Because you have to understand all of that. And it's fun. It's interesting.
The title of your book is The Credit Investor's Handbook, Leveraged Loans, High Yield Bonds, and Distressed Debt. Were I to have been your editors, I would have added a colon, read the footnotes, because that is effectively the most important message, I think, throughout in terms of the systematization of figuring out what other people aren't seeing. There's actually a passage that I wanted to read. I had marked this, and I kept holding up the book, so I lost it and had to find it again. But you were asking at one point, as an example, how to think about a company's liquidity. And if you don't mind me quoting you,
I love being quoted.
You say, before I teach my students how to analyze a company's liquidity, I ask how they've been trained to do this. Virtually every student brings up the current ratio, which is current assets over current liabilities. It's not their fault. If you Google how do you measure a company's liquidity, most search results include the current ratio. Most accounting textbooks and many professors discuss the current ratio as a measure of liquidity. And then you go on to explain why this is a perfectly useless measure of liquidity and outline a multi-step process that you would go through instead. And I'll save that as the spoiler for people who actually do read the book. But my question to you is what else are we being taught wrong? Like, what are the biggest shortcomings and failings of the less expert investor who might be beguiled by these kinds of frauds, or where they don't know what to look at? What are we getting wrong?
Well, one, thank you for reading that quote. I don't understand why the current ratio is talked about as a measurement of liquidity. It is not, period. I wrote that, and I'm much harsher. Like, the current ratio is a joke. It has no analytical meaning. It's fake news. I really hammer it, and then I hammer it again. But I don't know why that's taught. It's weird. And I send out that chapter to everyone, because what I didn't want is to send it out and then have prominent investors say, I disagree. Not one prominent investor disagreed. I sent it out to a lot of academic professors, and some of them were like, oh, maybe I shouldn't teach it. So the current ratio is a joke, period. And I tell my students that. I say, now, if you go to another professor's class and they teach you the current ratio and they ask you to calculate it, you could humor them and do it. Or, you can fight them, or you can tell them to call me and I'll give them the chapter to the book. But, professors teach it, accounting books have it. But what I would say, the problem with academia teaching, they don't teach credit. So they're teaching equity. Now, the reality is academia is going to be a little bit behind in everything to the practitioners. So as I said, Columbia focused on value equity, private equity. Now they have a credit track. Columbia
Wow.
Business School, they say you get into their value investing program. They no longer market it as value equity investing. They market it as value investing. And then you could take an equity focused track or a credit focused track. So Amir Surfi, University of Chicago, he's phenomenal professor. David Smith, University of Virginia. I think what's happening as credit has gotten more topical and hot, more and more people are going to start to teach it. I don't think I would say, oh, they're teaching it wrong, excluding the current ratio. They're just not teaching it. They're not teaching it yet. When you look at jobs, I believe the undergrad business schools and the MBAs need to be teaching their students the skills needed to get the jobs. And there aren't that many jobs in value equity investing.
Right.
I'm not saying you shouldn't teach it, but you can't teach it at the exclusion of how do I become a credit analyst when there's so many jobs in credit. And it used to be when I was a young man, they assumed you knew nothing about credit, and Citibank, Chase, all of the banks just would take you and put you through a credit specific curriculum. And most of the banks don't do that. They teach you how to become an investment banker, but they don't teach you how to become a credit analyst, which is different. There's overlap, but it's different. So what I would say to your question, Jen, I don't know if they're teaching it wrong. I just don't think most schools are teaching it. And at Fordham, because I got very involved in Fordham, I'm not an alumni. I went Cornell undergrad and Columbia, as I mentioned, but I fell in love with Fordham because I like that gritty, the Bronx. The kids have a healthy amount of, we're not Ivy League, so we'll
we
run
have a lot
through
of
a
Fordham listeners. Good
Yeah.
shout out.
I love Fordham. I love Fordham. I love the Jesuit value of giving back.
They're Jesuit?
Yeah, it's a Jesuit university. Myself and Bob O'Shea donated a fair amount of money to create this credit institute.
Oh, cool.
And we developed and teach a credit concentration. And with that, we have a whole giving back element to it. So that's my plug for Fordham, because I do love the kids and I love the university. And my students at Columbia always get a little pissed at me.
Well, it's interesting because so Jen went to Princeton, I went to Brown, and you don't learn anything business related at all. And it's like we graduated both 06, although I stayed an extra year and did a master's, so I was 07. But it's like you can get a job on Wall Street. And we were talking earlier about this idea that, I mean, with AI, a lot of some of the more junior roles are potentially going to be going away. So I do think that a lot of the universities, like they're going to have to start teaching this stuff. I mean, because otherwise, like, you're going to have young people that normally it was an apprenticeship model. Like that's how you learned, because so much of it was like you learn by doing. And if now a lot of the earlier jobs are going away, it just seems like they're going to have more tracks in universities to teach people. I mean,
yeah, it's a debate,
skills.
right? It's a debate. We could get into the philosophical debate, but the Ivy Leagues always felt, and they haven't been shy about this in my mind, that it's beneath them to teach business. So the closest they got was theoretical economics. University of Pennsylvania, through the Wharton School, was smart, and they said, we're going to teach business, and they dominated it. Cornell has now gotten into that, and they have a business track. But I don't know if the Harvards, the Princetons, the Brown will ever get into it. But I was at the Kelly School in Indiana, University of Michigan, Ross. I mean, I'm going to piss off students not mentioning all of them. But the Ivy Leagues, that's fine. You know, they want to educate the poets and the philosophers and men and women who will achieve great things. But hardcore, I want to learn finance, those places say you'll learn that when you leave. or learn it on your own. And people like you offer that, right? Who say, go to the Ivy Leagues and pay me $5,000 and I'll give you a course online that teaches you what they're not teaching you. And
ours is way less than that, but yeah.
Yeah.
Michael, as a former poet turned financier myself, I was an English literature major. I think we will have many people who, thanks. We will have many who wonder about the career path of being a credit investor, who will say, okay, well, listen, where do I start and how do I navigate this? I think one of the things that struck me is this sits at the intersection of both the fundamental type of analysis that Kristen was doing in the investment banking division of a bank, but also in the bond trading and investing side of the fixed income markets where I lived. I'm curious. Very few people can synthesize both kind of from birth, if you will, at the start.
Yeah.
So for you, I would say, is there a prescriptive path? Well, I'd like to see someone come from debt capital markets, from LevFin, as you mentioned early on, if they are looking to ultimately come join a team like mine. Or are there other potentially more circuitous ways that one could come to a path as a distressed credit investor?
Yeah. Don't fall in love with a specific asset class. Don't say, I want to do private equity. I want to do distress. In an interview, you might have that pitch of what do you want to do with, but in reality, don't have that. As I said, what you want to do is learn in those first years. And what I tell everyone is interview, and in that decision tree, number one is, how good is this on my resume? Your first job out of college, you want that resume builder. You want a big name because you do not know what you want to do in life. So get the big name. That's number one. Number two, get the department you're going to learn the most and has the most marketable skill. And number three, if you're fortunate enough where you actually have multiple offers, so you have a decision, who am I working for? What is their reputation in training, development, being there, helping me throughout my career? And you're only going to get the answer to the third component by networking, finding people who worked for that person, is at another fund who's going to tell you, oh, they're the worst. They actually went out of their way not to help me because they didn't want me to get more experience. They wanted me to only work for them. And you're going to get the other person that they say, I owe this person my life. They genuinely cared. So I would say, one, you're interviewing for jobs, wide funnel. One, it's great networking. Stay in touch with everyone you interview with. If you didn't get a job, call them, thank them, and ask them, hey, any feedback you could give me? That's how you learn. And some of the times it's like, there is them, but other times they say, look, you screwed this up. Like, this is what you did wrong, and you learn. So reach out after you didn't get a job, no matter what, even if you didn't want it. But at the end of the day, you do that. If you're saying, I want to get into Silver Point, where's our biggest recruiting? Look, we like kids that went through the big investment banking, LevFin, they self-select into that lifestyle. They're well-trained. So, you get LevFin, Goldman Sachs, Credit Capital Markets. Those are great jobs. All of the boutique restructuring houses, I worry about naming by names because I literally get a call. Why did you mention Houlihan and you didn't mention Evercore? I thought I was your friend. But all of them, the Evercores, the Houlihans, the PJTs, Lazard, Jeffries, restructuring. These are all great jobs. But at the end of the day, the most important thing is, one, you're going to go work somewhere. Do a good job. Your reputation will follow you. There is 1 degree of separation. When you're going and talking to someone, that person, if they send out an email to their contact list and says, does anyone know this person? Someone will know you.
Yeah.
Work hard, put your head down, and you need to have people like you. Don't be an asshole. Like, don't be that guy that everyone says really smart but sharp elbows, never liked him. That will haunt you 10 years from now. Every person you interact with is a really important person, and I'm going to make them feel really important. And it's important that they like me. There's a quote, and I'm going to butcher it, but it goes something like this. No one will remember what you did. No one will remember exactly what you said. Everyone will remember how you made them feel.
Yeah.
That is a really important quote. Yeah. When you're interacting with people senior to you, pari with you, or different, the person that is the receptionist, the person that is the admin, every person you interact with, part of your agenda should be, did they enjoy that interaction? Do they feel good about it? Because how you make people feel, they'll remember that for a very long time. And one, you'll just live a better life. You'll be happier. You'll have connectivity. The people who are in the janitorial service, and you see them every day, I know their names, no different than I would talk to the two founders of this fund. I know where they live. I know when one of their mom got sick. Treat every person like they're the most important person. It's good for them, but it's also good for you. You'll be happier and you'll be more successful. So I'll get off my soapbox. But if there's one piece of advice, that quote is a great one.
I love it. Thank you so much, Michael.
I appreciate it. Gotta jump. You guys doing great service, making the world a better place.
As are you, Michael. Thank you so much.
Thank you so much.
Okay.